Distinguished participants, speakers, moderators, it is a pleasure to join you today at the conclusion of our second BIS Innovation Summit. Let me start by giving a heartfelt thank you to all the speakers and moderators for taking the time to share their experience and expertise with us. The BIS Innovation Hub launched this conference last year to shed light on key technological issues, as well as on the cultural and organizational challenges that central banks may need to embrace to meet the challenges of the digital age. Technological innovation only moves forward, and central banks must keep pace. I'm happy to report that we had over 7,000 registered participants and on average over 1,000 people watching each session live. Thank you all very much for joining the sessions and engaging with us. Over the last 2 days, we have been privileged to host an outstanding group of global leaders from the public and private sectors. They have examined key issues about the future of money and payments, central bank digital currencies, CBDCs, decentralized finance of DeFi, new technologies in the financial system, green initiatives, and technology as an enabler of financial inclusion. I now have the significant challenge of summarizing all this knowledge in a few key messages. And I would like to pay particular attention to the role that technology can play in improving people's lives, by helping protect the environment and deepening financial inclusion. Yesterday and today, we heard about money, payments, technology, and innovation from both a policy and a practical perspective. As Augustin Carstens said in his welcoming remarks, the interaction of these elements raises questions that both challenge and excite us all. We are all witnessing how digital innovation is reshaping the world around us, including the financial world. This can lead to opportunities, but also challenges. New opportunities can promote increased efficiency and inclusion, but they can also come with risks of exclusion, instability, and fragmentation. Central banks need to stand at the forefront of these developments to ensure that technology is a force for positive transformation. They need not only to put in place policies to address these changes, but to innovate themselves. Think of it as a kind of a Schumpeterian process. The same is true for the BIS Innovation Hub. Together with our member central banks and a variety of public and private sector partners, we are building proofs of concept and prototypes using new technologies to address problems in the financial sector. With the Innovation Summit, we are bringing these experiments to global audiences as part of our work to foster international collaboration on fintech. Let me highlight a few ideas that I think have clearly emerged over the last couple of days, starting with money and payments, the theme of the first day. I will start with a fundamental point. Whatever the format, digital or hard cash, sovereign money must continue to have a central role in society. This important point was highlighted by President Lagarde from the European Central Bank in her conversation with Jos Lipsky. Others certainly agreed. As Augustin Carstens said in his opening remarks, money is the glue that holds the financial system together. Or, as Stefan Ingves from the Swedish Risk Bank noted, money is not about technology. Money is essentially what is in our head. Moreover, the roles of the public and private sectors should not change just because new technologies emerge. Successful private-public partnerships recognize that the public sector is responsible for the central infrastructure and the private sector provides the interface with the public. Central banks have a duty to establish a level playing field and enable competition. This allows new players to come in with new ideas to resolve old problems and cater to underserved parts of the market. A third important point, we need to ensure that public and private money continue to coexist, as has been the case through history. Central banks are not developing CBDCs in order to compete with private money. On the contrary, in a changing environment, a CBDC is the type of public common good that central banks can and should provide to ensure that the system is stable. CBDCs don't aim to be the only money to be used in payments ecosystem, but they will be the anchor around which other forms of money, such as commercial bank money or regulated stablecoins, can flourish. As the chairman of the BIS board, François Villeroy de Gallos, said, CBDC is not meant to be a big brother. Rather, it could be about providing further tools to help make decentralized finance and other innovations successful and sustainable. This is all true both domestically and internationally. The G20 program to enhance cross-border payments is an example of how the public and private sectors can both benefit when working together. Private companies need the public sector to address frictions in infrastructures, regulations, standardizations, and barriers to competition. This way, the private sector can deliver innovation that the public sector needs and doesn't do it as well. Moving to today's theme, technology and innovation, I would like to focus on two main dimensions: green finance and financial inclusion. First, digital technology can support the green and sustainable finance agenda. How? By facilitating the collection of better data. The speakers on the panel just before me explained how the collection of data and metrics can enable central banks, supervisors, and financial market participants to understand the environmental footprints of firms, sovereigns, and assets. Technological solutions such as blockchains, the Internet of Things, smart sensors, and GPS data can support these initiatives. Geopolitical tensions are accelerating the transition towards a greener economy. Supplies can be disrupted. Surging energy prices can drive up inflation. The world's dependence on fossil fuels exacerbates risks to the economy and the world. All of this calls for a heightened and sustained move towards renewable energies. New technologies can also help with this task. For example, an artificial intelligence algorithm can help incentivize investments in greener technologies by collecting and reporting on data that will inform investors' decisions. Our Hong Kong Innovation Hub Center did exactly that. In Project Genesis, our Hong Kong team developed two prototyped digital platforms for investing in government bonds that finance green projects. Over the bond's lifetime, the investor can not only see accrued interest, but also track in real time the reductions in CO2 emissions linked to the investment. Now, moving on to financial inclusion, the conference sessions today demonstrated how innovative technologies have been a game changer. We all heard that last year in Ghana, mobile money transactions accounted for nearly 82% of GDP. You also heard that 2/3 of adults in Brazil now use Pix, a digital fast payment system facilitating small transactions not yet 2 years old. Almost a quarter of all Brazilians have already used Pix to make their first digital payment ever. Pix demonstrates the enormous potential for technology to facilitate financial inclusion. In deepening financial inclusion, it is not just about technology. Policy is also critical. Emerging markets and developing countries are learning how to combine forward-looking public policies in such areas as regulation with the development of public goods, like new market infrastructures and retail CBDC. All this will harness innovation to benefit households and firms. Countries are learning that policies have to continuously adapt, and indeed, one of the key messages of the summit is that continuous adaptation needs to be supported by data. We cannot overstate the importance of granular data to help calibrate policy and regulatory frameworks, and build infrastructure suited across different segments of the population. There is yet a deeper nexus between technology and financial inclusion. As we have heard today, technology offers better access to financial services. Artificial intelligence can help us to make better financial decisions. There is a lot of potential in using non-financial data to inform financial decisions, or to bring into the system people that do not have a bank account or credit cards. But as we are all aware, this can imply significant risks to privacy and misuse of personal information. More deeply, if the technology allows for biases to get established, the decisions they spawn will be affected. Poorly designed computer algorithms can inadvertently contribute to perpetuate racial or gender biases and therefore inequality. Decisions can be biased unconsciously, either through the data on which the algorithm is trained or through the specifications of the operating algorithm. Central banks and regulators must innovate and develop state-of-the-art technologies to use and transform data capabilities in ways that serve equally all segments of the society in a transparent and open manner. Finally, I was pleased to see so many speakers in the conference recognizing how critical partnerships and international collaborations are to achieve better outcomes for a more sustainable and inclusive economy. We at the BIS will keep working with stakeholders in the public and private sectors to ensure that technology is a force for good in the financial sector and for the society more broadly. Let me finish by again thanking all the speakers and all viewers for such a successful Innovation Summit. See you again next year, and thank you very, very much. Goodbye.